So Dave is the founder of 500 startups, but in the 20 years in the Valley, he's been an entrepreneur, an investor, an advisor, a blogger, and what else? Many.
I can't keep a job. It's really been tough.
Okay, Dave, so welcome. Welcome to the club.
Thank you very much. I'm going to give a talk that's called the Lean VC, and some of this is going to be on the investor side, some will be on the entrepreneur side. I'm happy to take intelligent questions in the middle, but try and hold a few of them if you can. I really spent a lot of time doing a lot of different things in the Valley. I would not say that I've been tremendously successful at any one of them, but I'm still working at it. Spent a few years as an engineer, a few years as an entrepreneur, a few years as a marketer. More recently, I've been doing investing. I'm going to talk a little bit about some of my experiences over the last few years in investing and what I'm trying to work on these days at 500 Startups, which is our seed fund and incubator. For people who want to follow along, a pretty similar version of these slides is on SlideShare. I just tweeted out that link, but it's slideshare.net/DMC500hats. I'll try and make that a little bit easier for folks in the future. So there's been some changes in the last few years, some over the last 2, some over the last 10. With respect to venture capital, there's been quite a significant amount of change just in the last few years, somewhat as a result of the recent financial downturn 2 years ago, some as a result of the financial downturn 10 years ago. But in general, what's happening is that there are fewer large funds, probably fewer funds overall, a few new small funds, and then I think there's, maybe there's a little bit better IPO market this year than there has been the last few years, but overall the trend is towards smaller acquisitions, at least more of the small acquisitions. There's still a few larger ones. I'll go into a little bit about what I think is happening in the rest of venture capital. At the same time, there's also been an emergence of a large number of distribution platforms. So in search, Google's been around for maybe 10 or more years. On the social platform side, Facebook, Twitter, and YouTube have emerged over the last 3 to 6 years. And then just recently, in the last few years, mobile platforms, Apple and Android. Those are the ones that we're currently focusing on. There's definitely others, but those in particular are interesting for us. And then starting maybe around 2005, although Bill Gross and other folks started doing incubators late 90s, I think the more modern version has been popularized by Paul Graham, Y Combinator. And that's really doing a lot of small experiments or a lot of startups on a relatively small budget. There are others including Techstars, Seed Camp in the UK, here in San Francisco also AngelPad, BetaWorks in New York, and others. I ran a program for Facebook and Founders Fund and Excel a few years back. So I'm going to talk a little bit about each of those. If you guys think those are interesting, that's great. If not, tough shit. That's what I'm going to talk about. So my background, I think I covered this mostly, but I started out as a geek and entrepreneur. I grew up in, born in West Virginia, grew up mostly in Maryland and West Virginia, went to Hopkins, came out here pretty soon after that in '89, just in time for the quake in '89. I started out as an engineer, then gradually, before I knew what I was doing, ended up running a small consulting company. Pretty much didn't know what I was doing, so kind of the classic engineer starting out as an entrepreneur, made a lot of mistakes. Managed to get a small acquisition out of that, nothing too huge. And I was at PayPal for probably about 3 years during some of the darkest days in the Valley. 2001 to 2004 was a tough time to be in the Valley if you were not working for PayPal or Google or a few firms that were doing okay, eBay also. But a lot of people that came here in the mid and late 90s left here in the early 2000s. And there were tremendous upheavals in the financial markets and the technology markets. How many people were actually here between 99 and 2000? Yeah, okay, so some of you may know that whole story. So we kind of emerged from that world in 2004 or 5 to a slightly better funding environment. At that point, I left PayPal, started running marketing at Simply Hired, and then later was doing some consulting with Mint and a few other companies. But started doing angel investing in those few years and really became more on the investment side. So a few years as an engineer, a few years as an entrepreneur, a few years as a marketer, a few years as an investor. So like I said, I have a tough time keeping a job. Oops, excuse me. So these days, a few investors have been foolish enough to give me some money, and we opened a fund last summer called 500 Startups. This slide's a little out of date. We're actually probably at 101 companies already, so we're pretty different in a lot of ways from other funds. The most obvious one is that we do a lot of investments, but we do those at relatively small size. Our median investment's probably around $75,000. In addition to a number of investments, we focus a lot on domain-specific skills in design, engineering, and marketing. And we like to use the keywords design, distribution, and data. I'll talk more about that as well. And we're both a seed fund as well as an accelerator program, which is the more polite form of incubator if you think incubator is a bad word. As an individual angel investor, I did 13 investments between mostly 2004 and 2008. About $25,000 average investment. The one notable success of that was Mint. Two others that I wasn't an investor for, but was an advisor, Bix and Jambool, also were acquisitions. And then a few others I'm pretty optimistic about, SlideShare and Simply Hired, Mashery, probably a few others. But in general, I learned a lot, and learning a lot is what happens when you don't actually always have success, about angel investing. More recently, I worked at Founders Fund and ran two different programs. One that was an in-house seed fund, about $2 million. We did about 20 investments at around $100,000. And another one where I ran a joint venture program for Facebook, Excel, and Founders Fund. It was sort of like an incubator program for Facebook. So I'm sorry for the long commercial, but some of this is relevant to the talk, mainly because, again, there was a large number of investments we did at small size. So we did 43 deals. I did basically 43 deals in about 15 months for slightly less than $3 million in capital. And then, like I said, we've done about 100 investments out of 500 startups. And I don't want to belabor you with all that, but we're going to probably dive into a model that I think is a little bit more suited for the current market, at least for internet investments, mainly because production costs for internet startups are much lower, but also distribution and customer acquisition costs are much lower, or at least more predictable. Most people understand the first point. Not a lot of people understand the second point. I'm going to talk about why our investment model, I think, works better with both of those two things happening. So there's still a place for venture capital, certainly, at least as constructed over the last 10 years. I'm not trying to say that that should go away, and many of those folks I work with all the time. But there's been a lot of changes over the last 5 years at the seed fund level and at the incubator accelerator level. So some people call that super angel, some people call it micro VC, whatever. I'm going to talk about what I think those changes are. So if you looked at sort of the overall, lay of the land, and there are plenty of others, but I've tried to, illustrate some representative funds here. The bottom layer, benchmarks and Excels of the world, generally managing funds that are probably north of 250 million. I think probably Benchmark and Excel are managing funds that are anywhere in size from 500 million and up. They may be managing 3 or more of those funds at any time. They're generally making very large bets. Typically at least $1 million, but probably more like $5 to $20 million, in some cases even more than that. And they're aiming for billion-dollar home run exits or more. Excel's been very fortunate in the last few years, both with Facebook and with a bunch of other things. At one level down from that, you have other funds that are operating in the $50 to $250 million range. First round capital probably started maybe 6-7 years ago. I'm not exactly sure. Josh Koppelman. And they've been doing a lot of seed round and A round investments, and they've been pretty aggressive, doing a lot of deals themselves, maybe upwards of 50 investments a year. True Ventures is also at that size. Next stage down, Ron Conway's been doing this for quite a while, but then other folks, Mike Maples and Ann Mura at Floodgate, Aiden Sencut, who's an ex-Googler at Felicis Ventures, Jeff Clavier with Softtech Ventures. So operating funds that are in the $10 to $50 million range. I think actually Floodgate's probably more like 75 million. And again, they're doing a lot of seed investments, and again, more of them. Ron's probably doing, close to 100 investments a year, probably somewhat similar to the scale that we're doing. And then angels and incubators probably have kind of filled in the last 3 to 5 years, although there have been angels for a long period of time. Again, starting with Paul Graham and Y Combinator in 2005, and maybe Techstars soon after, and then many others in the last few years. Really small investments, so anywhere from $0 to 25,000, maybe up to 100,000. In a lot of companies. I think Y Combinator right now is doing 45 companies in the current batch. They'll do 2 batches a year, so they're probably doing at least 75, maybe up to 100 investments a year. I think Techstars is doing 10 companies per city in 4 cities right now. We're doing probably on the order of 50 incubator investments and maybe 50 to 75 seed investments a year. So the top end of the food chain is kind of lots of small investments. Bottom end is small number of large investments. And they're not really in competition. They're kind of more of the overall ecosystem. It's just that, you know, probably the seed funds and the angels filled in a space where all of these other VC funds used to be maybe 10, 15 years ago, except that they've grown funds larger and moved downstream. Potentially now they're not really doing venture investment. In many cases, they're doing more mezzanine fund, late stage investment prior to companies going public, in some cases even investing in public companies and taking them private, more LBO funds or leveraged buyout funds. Two kind of significant events that occurred. One was sort of dot-com blow up in 2000 and 2001. So the thing that was going on at that time was a lot of retail market insanity and institutional investor insanity. So a lot of people buying IPOs or buying into IPOs for companies that really didn't have much revenue. You know, it was mostly a lot of hype, a lot of investment bankers who took those companies public, a lot of venture capitalists who plowed money in, really did not give a shit about what the hell was going on with the business models of those companies. As long as they saw people buying those companies on the IPO market, they were happy to invest and kind of shove companies out the door. Really unsustainable behavior, really not very productive at all. And although you hear a lot about sort of the pets.com and the internet startups, what was really more destructive was the telecommunications companies, which were probably 5x, maybe even 10x the amount of capital that was going into internet companies, which was not small. So there was a lot of money wasted in internet companies, but there was a lot more money wasted in fiber and infrastructure companies. So all that shit blew up for the most part. And a lot of people were sad and out of work. And the Valley took probably 3 years to recover from that. The years 2001 to 2004 were pretty dark. But eventually we got a little smarter with that stuff. A couple of things happened during that time frame. So one was the large change in internet monetization from advertising, Yahoo probably the bellwether poster child of the day, display-based advertising, and Google, you know, coming out and starting to do CPC-based advertising, which is at least arguably based on some real activity and people clicking on things that later potentially convert to transactions. So there was, you know, a collapse in spending and investing that was going on in internet companies. There was a collapse in spending on display advertising and the sort of move into more performance-based advertising, at least CPC-based advertising. So if you thought about it from sort of a rationality standpoint, a little bit more rationality, maybe a lot more rationality was introduced into the market, but there wasn't a lot of people betting on internet startups until maybe 2003, 4, 5. There started to be more activity going on. And then during 2004, 5, 6, you know, again, a lot of enthusiasm happening. And then what happened 2008, summer 2008, I was actually trying to raise a fund at the time. Great timing. The debt markets blew up, financial markets, housing markets blew up. Now, the thing is, there really shouldn't be any impact for what's happening in the consumer internet world with respect to debt markets and financial markets in housing. Those two are not really connected. If you looked at the overall internet and e-commerce markets, that's largely based on number of people online, whether they're spending online, and even though there was tremendous dislocation of what was going on in the US market in finance and housing, people didn't stop buying stuff online. Maybe there's a drop of 10 to 20%, but there wasn't that much drop. I think Amazon's revenues were flat in 2008 to 2009. Google's revenues were up. Certainly other people's revenues were up. The overall picture, China's coming online, India's coming online, Europe is growing, more other devices being introduced to users old and young. So the overall trends for internet startups were very good. But one thing that was sort of screwy is venture capitalists were heavily impacted by that change in the market. Why? Because their investors' portfolios were impacted, right? So the people who invest in venture capital, They also invest in the stock markets and bond markets, and their portfolios were hit for probably 30 to 50%. The other thing that happened, and venture capital is measured in 10-year periods usually, is the window of performance of venture capital, which was great in the late 90s, gradually kicked into 2000 and 2001, in which it was terrible. Right? So a couple of things have happened in the last 2 years was that big dislocation happened. People who invest in venture capital all of a sudden didn't have cash, right? And their overall portfolios are based on asset allocation strategies, which are percentage-based. So now their public market ownings were cut by a third. And if they needed to rebalance their portfolio, they probably wanted to cut their venture capital private equity holdings by a third. And then if they looked at the performance of venture capital over the last 10 years, oh my God, that was crappy. So we probably want to reduce our asset allocation in venture capital. And we don't have money anyway. We're not liquid, so we can't invest in new funds. So venture capital funds got hammered, right? Their investors didn't have money, performance in the sector was terrible, and as they were rebalancing their portfolios, their asset allocation to that class was being reduced, right? So people raising venture capital funds, all of a sudden in a world of hurt. The rest of the market recovered pretty quickly, so I'm sort of stealing a little bit of thunder from my slides further. Yeah, I'll come back to some of this. This is the one that I wanted to kind of talk about, right? So how many people saw Sequoia's RIP Bad Times presentation? Oh, really? The rest of you don't know about this? Okay, so
It's been all over, right?
yeah. So this was 2 years ago, right? 3 years ago, 2.5 years ago. Sky's falling. Everything's falling. No more venture capital. Fire everybody on your staff. This was a message from Sequoia to their Series B companies largely that were not profitable. What they were saying is, we think there's going to be a lack of funding going on because they were remembering what happened 7 years ago, 8 years ago at the time. Right? Batten down the hatches, no more funding available. Try and get to break even as soon as you can. So these big-ass companies that were not profitable and were growing and hiring people, fire people. In fact, companies that were doing well, LinkedIn, fired 10% of its staff, I believe, around that time. Questionable whether that was really the right decision. Certainly a year later, they were predicting no more funding for 5 to 15 years, depending on what part of that deck you were looking at. Really pretty aggressively bad news predictions that were pretty much absolutely wrong. Within a year, that market, at least investing in startups, was back and active again. Maybe not at huge valuations, but it was back and active. And certainly 2 years later, it's incredibly active, right? So they were wrong in a number of different areas. What else was going on? Like I said, users and bandwidth bigger, startup costs lower, transaction dollars monetization better. So everything from a macro perspective, if you were an internet startup company, going great. The only thing that was really changing was the people who were providing capital to that sector, their world was massively changing. So really different things going on for venture capitalists versus internet entrepreneurs. And I'll come back to the parts about product and customers. So kind of that's a little bit about the world of venture capital and the changes that have been happening recently. And again, I'm going to say that venture capital is still relevant for many industries. The two things that venture capital was really originally put together for is large product development cost and large customer acquisition cost or long sales cycle. So originally, 30, 40 years ago, venture capital was put in place for risky industries that were building big iron, big software, like things that were 3 to 4 year production cycles and large costs, and then maybe 1 to 3 year cycles in customers and acquisition, and maybe a few areas of funding that would take them to get public, right? So the cycle time for these companies was anywhere from 5 to 10 years. Lots of capital required, at least on a relative basis. That's still true, to some extent, for hardware companies, maybe enterprise software, clean tech, bioscience, things that are CapEx intensive. And for certain internet companies, Facebook, Zynga, and Groupon, at least, have chosen to raise very large rounds of capital. And those are the companies that everybody kind of says, at least the larger venture capitalists use these examples for why venture capital is still relevant and why you still need lots of dollars to go, build big companies. And I would sort of agree with them, but I would also tend to disagree with them that a lot of the growth costs of these companies, once they found their business model, customer acquisition cost, I don't think in the future will be financed on equity terms. Particularly if you can prove that customer acquisition is a profitable exercise, that should probably be done on debt or high interest rate debt that might be convertible to equity. There isn't really a lot of people providing that type of financing right now, and this is kind of more advanced thinking, but I will say that largely those companies, I think, are doing financings to increase their market cap based on the market. They're not really doing it because they need to do equity financing, or they're doing it to cash out some of their ownership and holding. What is happening for a lot of consumer internet companies, at the very least, is there's a small amount of capital required to build the product. There's some amount of capital required to get the customers, but they're much less than ever before. And then in at least a few of these other areas, there's not much cash required. So venture capital traditionally been a place where large amount of capital was needed and long cycle time. Consumer internet businesses, generally speaking, not either of those things now. Doesn't take a lot of time to build product. Doesn't really take a lot of time or effort to acquire customers because of the growth of these platforms. Other thing that's been going on is we've been in around the business for 10 or 15 years, and there's a lot of technology companies now with a lot of money around, with a lot of customers around, and maybe a lot of bureaucracy and not as much innovation. And so if you have a lot of money and you have a lot of customers and you don't have a lot of innovation or you have a lot of bureaucracy, what's the natural path? You should be starting to outsource innovation and buying a lot of small companies, because you have way more customers than these small companies do, so your marketing and distribution costs are dramatically less than theirs, and they maybe have a lot more innovation than you do. With the exception of maybe a few companies like Google, Apple, and Facebook, which seemingly can still do a lot of innovation at large scale. Most of the rest of the large companies, and even somewhat those companies, have some trouble in producing innovation. And typically that's just the story, right? As you get bigger, you get caught up in your existing lines of revenue, your existing customer base, it becomes harder to innovate, innovator's dilemma. So what else is happening? Public companies that are not technology companies. What's been happening to their users? All their users are moving online. A lot of their sales are moving online. Maybe 5 to 10%, maybe even up to 15% of some of their sales are now online. And in the future, probably 10 to 30%, maybe even more of their sales will move online. So what we're seeing is large, non-technology companies that are public having to figure out internet distribution methods and sales. They're probably not too good at that. What's their natural reaction going to be? Going to go buy other companies. Probably not going to buy big companies. They might, but they'll probably buy a lot of small companies, maybe 25 to 50, 100-person companies. If the sales price is $25 to $100 million, that's a great way for them to go get some innovation, get some talent that can help teach them about technology, but also about online distribution. So we have a lot more mature internet platform companies doing acquisition for innovation reasons. You have a lot of public companies that are not technology companies that are going to start doing more of that acquisition in order to understand about internet distribution. What does that mean? Great time to be an entrepreneur. A lot of acquirers likely happening. If you have some understanding of a product vertical and some understanding of internet distribution or sales, maybe there's a lot of people out there willing to buy your company, particularly if you're willing to sell at below $100 million. What else has been happening? Less cost required to build those companies. So the entrepreneurs who are running those companies own more of the company, and they don't really need to wait until they get to be $1 billion, unless they're Mark Zuckerberg or Reid Hoffman or a few others, to sell. If they care about the economic side of the equation, probably it's somewhere between $50 to $100 million. They've got a pretty big payday. If they own 20 to 30% of the company at maybe a $50 to $75 million sale, they've probably got take-home after tax anywhere around $10 million, maybe. In many places in the Valley, we would consider that to be fuck you money. In other words, I never have to work again. Anybody pisses you off, you say fuck you, because I've got all the money I need. Right? So if you are a rational person, there is no reason to take excessive incremental risk beyond the potential sale of a company that gives you enough money that you never have to work again. There may be other reasons, right? Money is not the only reason that motivates people. But from an economic, rational standpoint, there should probably be a lot of things happening at the $50 to $100 million kind of exit trajectory that are motivating the entrepreneur to sell. So now we've got all these things happening, right? We've got large, mature companies in tech that are buying. We've got non-tech companies in the public sector starting to buy tech and distribution to figure out. We've got lower capital kind of production costs, larger ownership for these entrepreneurs. All of a sudden, there's incredible amounts of reason for sales to start to be occurring around $50 to $100 million, right? Now, what has happened in the internet investment world? Not much, right? The birth of these seed funds and the birth of these little angel funds and incubators, maybe. But there's a lot of people, here's the weird thing, right? All these huge crashes happened in 2000, 2001, right? Really unsustainable behavior. And what happened in venture capital? Anybody, what happened in venture capital? Primary thing that started happening with venture capitalists in 2000 to 2005. Angel, sorry?
They dried up?
They dried up? No, not at all.
Angels came in and filled the gap.
Sort of, but not really. Not in 2001 to 2005. It's completely irrational behavior, right? They raised bigger funds. Incredibly large venture capital funds were raised in between 2000 to 2005. No rational reason for that whatsoever, except that people were starting to freak out about housing and were starting to shift money out of housing into the other sectors, right? And venture capital was strangely viewed as a slightly less irrational investment than housing. Not sure about that one. So you just had this huge crash in the sector, and still people were raising big-ass funds. Why? Because the lag time on the institutional investors is 10 years, right? They look at asset class performance because venture capital funds are 10-year illiquid vehicles. Usually when you invest in a venture capital fund, you're investing in a 10-year vehicle, and you can't get your money out unless you take a real penalty for early withdrawal on that. Right? So their performance time, I don't know if this is kind of like a lot of history and weird stuff in venture capital, but what's going on was like, you know, this really unsustainable, crazy behavior just like crashed the market, and we're like, oh, that probably shouldn't work. And the institutional investors are like, here's more money, right? And we're looking at, okay, it costs less to build these companies, and yet venture capitalists are putting more money into companies, right? So really wacky, out of, you know, not logical behavior. And now, you know, so I'm going to stop for just 1 second and say a lot of this M&A has been starting to happen, and I think Mint.com was a company I was an investor in, kind of classic example of that. Even though Mint raised a fair amount of money, they raised initial seed round I think of 750,000, an A round of 4 million, which I was part of for a small check, a B round of 12 million from Benchmark, and then a big-ass round, I think, of 30 million from some other folks, but then they sold right after that. So really, they probably used about half of that $12 million round. So for less than 10 million that they really put into the company, they built this business in 2 or 3 years and sold it for 170 million. So very efficient use of capital in the first few years, building a business that they then sold to Intuit for a pretty decent sum. And whether you think that was a good or a bad thing, Aaron Patzer, the founder, probably walked away with a fair amount of money in his pocket. That's what's going to be happening a lot more in the future years. You're not going to see a lot of the Facebook and Google and YouTube and Skype things, but you're going to see a lot more of that between $50 to $150 million sort of sale, because they had built enough of the business and he owned enough of the company and there were enough acquirers that sort of there was a rational transaction that occurred there. Okay. One other thing that was going on in the last few years, all these growth of platforms. So what, with the exception of maybe one company there and one other company that's been around longer but products weren't happening, how long ago have these companies existed?
8 years.
8 years? So Google has been around since maybe 99? 98, 99?
But Apple, you're talking iPhones.
Apple's been around forever, but iPhones pretty much in the last 3 years. YouTube started in 2005 by some folks that I used to work with. Facebook started in 2004, but really mainstream use probably in 2006, 7, 8.
LinkedIn maybe a year and a half.
Twitter started in 2006, mainstream use in the last 2 years. LinkedIn started in 2002 or 3, I believe. I was still at PayPal when Reed started that. Again, mainstream use in the last few years, and Android still coming out. So for the most part, these things have happened in the last 5 years. And with the exception of LinkedIn, I think every one of those is a 100 million user platform. I'm not sure about the numbers for Android, but Google is hundreds of millions, if not maybe north of billions. YouTube, probably 300 million, maybe more. Facebook, 600 million. Twitter, a couple 100 million. iPhones, 100 million, probably more if you count iPads. LinkedIn, high tens of millions, maybe hundreds of millions. Android, probably easy 100 million. So like all those, hundreds of millions of users in the aggregate, you know, you can probably reach 1.5 billion people in the world, maybe 2 billion on PCs, maybe you can reach 3 billion on smartphones and feature phones if you go further. Incredible distribution and reach on these platforms, largely in the last 5 years. At no other time, what?
It's becoming faster.
Becoming faster, right? So at no other time in previous history could you ever have this much choice as an entrepreneur. You know, it's basically Venice sorry, 14th, 15th, 16th century? 15th or 16th century. For entrepreneurs, for internet entrepreneurs, it's the Italian Renaissance. It's happening right now. It's a great time to be building businesses.
Just a quick
Yes.
question on this slide. You're mentioning the platforms?
Yes.
But there's one platform that is conspicuously missing, which is local.
What did I miss? Which one?
Local.
What does local mean?
Local, Groupon, Foursquare, those types of...
Okay, it'll be a platform in another 2 years. It's not a platform right
Just
now.
Lord.
Where do you go to get local customers?
Okay.
Like, tell me how you access that market.
Try to...
Place an advertising deal with Groupon?
Yeah, probably, or Foursquare, or try to
Yeah,
do something.
Foursquare, come on. 6, 7, 8 million users right now?
It's not there yet, but
It's not there anywhere near. Another 2 years at least.
Okay.
Yeah. So yes, I agree with you. Huge potential market. And I think the answer is Facebook is the local market. So they are on there. The other one I thought you were going to say was Zynga. So I thought you were going to say, at least from the US market, and this is a US and European-centric view of the world. This isn't really an Asian-centric view of the world. There's different companies that would be on here if you were Asia. So anyway, my point is, yes, there may be others that we've left off here, but the fact that I even have more than 3 is amazing. Right, so I've got Google in search, I've got Facebook and Twitter and maybe LinkedIn and social, I've got YouTube if you care about video, and maybe in the future I've got Hulu and Netflix and maybe now Facebook, and I've got all this stuff. So it's amazing amount of choice and distribution. And again, we said more users online, lower startup costs, better transaction monetization going on. So building the product, cheaper, faster, better, getting customers. This is the one that I think most people have not really thought about, at least from an investment standpoint. It's more measurable. It may not be lower cost, but it's more measurable, much larger volume. So as a single person entrepreneur, I can reach billions of people, right? Literally, I can reach billions of people if I'm willing to localize. I can reach hundreds of millions of people even if I don't localize, right? Small teams can have incredible reach. And monetization, which they didn't used to have, most people who are online now are able to conduct some form of monetization, even in developing countries where there may be imperfect infrastructure, they're starting to be able to do monetization. The other thing, what's cool about all these internet startups is you can measure a lot of behavior in close to real time. Maybe not in perfect real time, but within a 24-hour cycle, certainly within a week, you can see reactions to your products. Really interesting. Like you can make decisions and figure out stuff very quickly. So if I thought about sort of platforms from kind of this features, users, money perspective, this is what I would say is the definition of platforms. What do you think? What do you think is most important? Anybody? What's most important of those 3 things? Users. Okay. I would tend to agree. What do you think is second most important?
Features.
Features, money. Who thinks features? Who thinks money? Okay, about evenly split. I think money, but you could argue features maybe are interesting. I think there's always something that you could call a feature. There's not always something you can call money. So Facebook and Twitter, pretty great distribution platforms, pretty shitty monetization platforms. Facebook's starting to look better on the monetization. Apple, not the best distribution platform unless you can kind of get in the rankings, but great monetization platform, right? The hope is in the future that with more competition from Android, there'll be better distribution options on both and good monetization options on both. But I think from a startup, when you think about platforms, most people who are geeks think about features. Most people, business people, should be thinking about distribution and monetization. And if I look back at that list, each of these guys is starting to figure out those pieces. Right? They all have their own features. A lot of them have distribution. Some of them have monetization. Some have both. But in the near future, the next 2 to 3 years, most all of them will have both of those things worked out. Twitter maybe still has to figure out the monetization component, but Facebook's starting to figure out the monetization. The others, I think, certainly will. So that means wonderful things for startups. Yes, question?
Doesn't one actually sometimes contradict the other? For example, the more users they get, sometimes the less money you get, and the more you're focused.
I don't usually think that.
Well, think about all these super VC. I mean, you have all the expertise there. Think of all these super VC-funded companies like Facebook. For a long, long time, they were like revenues. What revenues?
Well, okay, so I see what you're saying there. I think from a company standpoint, there's often a trade-off between user acquisition and profit. From a platform perspective, I don't think that's actually the same operative thing going on. And the other thing is that the press is magnified around companies that accept venture capital. There's a lot of other companies that don't accept venture capital and you don't hear too much about that do great on monetization. And the porn industry is one of those big sectors, but there are others. So like, I generally don't think that's the case. In fact, I think Facebook in particular has really shitty per user economics. Because of that, I think they've gotten great at a lot of other things. But if you sort of took, let's say, 3 companies that had an easy route and 3 companies that had a hard route, Google, Yahoo, and Microsoft, probably pretty easy route to monetization, figured something out early, just started printing money. At least Yahoo did during the early days when a lot of distribution CPM deals were being done. Amazon, PayPal, and YouTube, maybe also Facebook, at least up until recently, pretty terrible economics, or took on a lot of debt and really didn't quite figure out the business model early, right? Although Amazon sort of knew what they were doing, but just like borrowed a huge amount of debt, right? PayPal almost like killed by fraudsters, almost killed by banks, almost killed by legal, like all sorts of things. YouTube, kind of shitty economics, got bought, but a lot of innovation that was happening at YouTube. So I think people who have shitty economics are forced to do a lot of other things to survive. Yes, sir. And people who make a lot of money early get kind of lazy, right? So eBay was another company that sort of had a really early revenue model that, you know, allowed them to be lazy in a lot of areas. I say that because I worked there. Question in the back, yeah.
Yeah, Facebook has bad monetization.
It's going to get better. It's getting better fast. What?
How is Zuckerberg worth $6 billion?
How is Zuckerberg? Okay, so let's do this math. This one's a really interesting, right? So right now, recent secondary market valuation, $75 billion, 600 million users, right? So it depends on whether you're counting 600 million users or let's say 300 million active users, or if you really want to get around to it, let's say active users in developed market economies where probably average GDP is $10,000 or north of that, right? So there's probably, guessing, 150 to 250 million of those users in developed economies that are regular users. It's called
talking like $6 billion on paper, like they were saying in the .com era.
Whatever, right?
Worth that much money.
So anyway, personally, I'm slightly biased. I have a really small amount of Facebook shares as a result of the work that I did with Founders Fund, but I'm probably a buyer even at $75 billion valuation, and I'll explain why. So let's say there's 150 million regular users in developed economies around the world, and a $75 billion valuation. So not sure if I can do the math here on that. That's on the order of $2,000 per user, something like that, the market cap. Am I kind of correct there? Right? So that's kind of rich when you think that right now they're generating about $5 a user currently, right? So they've figured out payments, at least for digital goods and casual games. There's at least rumors recently, somebody said that they were starting to stream movies from Facebook, right? There's been discussions, I know, that are happening with physical goods manufacturers and Facebook, and many of them would say, if you only charge me 5% instead of 30%, I would definitely, you know, accept Facebook credits. And PayPal's a very good example of that. PayPal is in use by a lot of large merchants as a payment type, and PayPal users may be on the order of 75 to 150 million users, right? Probably infrequent use. So Facebook already has a lot more regular users than PayPal, and PayPal is in use by maybe 3 to 5% of volume of merchants that use it, right? I think you'd see a lot larger adoption of PayPal by merchants, assuming they can manage the fraud. So if they go that direction, you could easily think that in the next few years, 5 to 10% of all online transactions might be done by Facebook. Could even be more than that. Local deals, social commerce, there's all sorts of reasons why you might think that it's pretty easy to think that Facebook could start to make between $50 to $100 per year per user. And that 150 million users might grow to 250 to 500 million users. And so now I've got an order of magnitude increase in the dollars per customer, maybe 2 orders of magnitude. I've probably got a linear increase of 3 to 5x in the number of customers. And now it doesn't look quite so crazy. We're doing $5 billion in revenue this year estimated, maybe $2 billion estimated profit. You know, you add a couple more zeros to that, and all of a sudden you're pulling down $10, $20 billion a year in profit. $75 billion a year looks like a real bargain. if those things keep happening. So it's, you know, maybe a little bit speculative, but not nearly as speculative as most people think.
Do you think there's, you see what Facebook is doing, and you see how many big companies are actually moving their active presence from the web into Facebook?
Yeah.
Is that a monetization opportunity for Facebook?
Probably if they start selling stuff off their fan pages. And if you thought that they might take Facebook Connect and use that as a payment method, even not on their fan page, but on their website. Anyway, so I don't want to focus too much of the conversation on Facebook, but okay, one more? Yeah.
You talk a lot about why these platforms are amazing for distribution and getting users, and how easy it has become to start and build companies.
Yes.
The challenge with that is, like you said, you're going to find 100 companies, so are 3 other incubators.
Right.
There are thousands of startups getting started every year.
Right.
And so competing for the user's attention, the media attention, or all the ways in which you would get that distribution.
Right.
It feels like it's become the new rare commodity.
Right, so I agree with that statement, which is that there's lots more competition. I don't necessarily think that's a bad thing. I think the internet economy can tolerate thousands, even tens of thousands of businesses, maybe hundreds of thousands, but it does get crowded. And I think what you also see is that people will start to focus more on niches and customers. So the typical thing about large venture capital is they're pushing people to go after really big sales, billion-dollar exits, large swaths of the market, right? And I would say, actually, I'm much more interested in somebody who can focus on a very specific customer demographic, right? So if one investor is saying, I want you to go after all women, right? And another investor is saying, I want you to go after all mothers. Another person saying, I want you to go after all mothers ages 20 to 27. And nobody says, I want you to go after all mothers ages 22 to 25, Hispanic descent in the northeastern region. Like, I can design products much better, right? I don't worry about this person who's designing products for moms, because I'm designing products for women ages 22 to 27, Hispanic demographic in northeast region. Really targeted, right? And you can even keep going from that. How many women ages 22 to 27, Hispanic origin in Northeast? Well, probably still 1 million. I don't know, at least hundreds of thousands. Can I build a business on hundreds of thousands of people? Yes, I fucking can. Really pretty easy, right? If I get conversion on maybe 2 or 3% of those and I get 5,000 to 10,000 customers and I'm charging them, I don't know, $10 to $20 a month, you know, yeah, you can build a pretty interesting business. You can build single-digit million-dollar businesses easy. You might be able to build $10 million businesses, right? So I think specialization and niche kind of opportunities, because you can target users so much better and you can get specificity and get distribution on this stuff, you can really start zeroing in on the products. Products are going to get better. They're going to get better because they're going to design right for you, right? And as long as I can get enough customers to sort of sustain my business, and my business might be 5 to 25 people, right? I can be break even on a couple $1 million in revenue. A couple $1 million in revenue is maybe 10,000 customers, you know? It's not that much. So yes, there's going to be lots of businesses out there, but there's going to be lots of specificity, I think, too. And there will still be big companies, right? But you can really define the customers a lot better. And I've got all these different ways to go after them, and I think we're going to get better at that, too. So, you know, it's taken 10 years for us to get from, you know, pets.com stupidity to sort of tactical, you know, sort of building these products for very specific customers and, you know, capital efficient production cost and capital efficient acquisition cost. But we're really getting a lot better at this stuff, right? And these big platforms are starting to provide the layers and the plumbing and the infrastructure for social platforms, for search, for commerce, for all sorts of other things. And largely, they're not competing with the smaller companies. They're providing layers of infrastructure for the smaller companies to go after. So what does it do to my business model? Well, in many cases, you're just reinventing the 1.0 business and then adding in some other components, right? So I still think most businesses are around selling stuff to people, solving a problem and selling them something, whether it's a physical good or a digital good, whether it's a single transaction or a subscription. You know, it's pretty straightforward in many cases. And then you have these search, social, and mobile platforms, which are huge, which allow you to get distribution. And there's some basic things that people everywhere are starting to use. Email, SMS, online payments in multiple ways, right? And then distribution is the underemphasized thing. And one other thing that's not on here is sort of design and user experience is also improving quite a bit. Apple kind of leading the way on that, right? And so, you know, we have this, how many people have an iPad? Yeah, how many people have 2 iPads? Some people have 3 iPads. So my bet is that in a year, about 20% of you will raise your hand that you will have at least 3 iPads, and 50% of you will have 2 iPads, right? Or 2 tablets, right? So these are amazing. I mean, if you have kids, like, 3 to 10. So I've got a 4-year-old and a 6-year-old. These things are awesome, right? I got one for my mom, I got one for my wife, I got one for my kids. You know, it's tough, I think, for older generation because it's a little bit hard to, the UI is not perfect for people with like tougher eyesight. But still, my mom likes to use it a lot. I'm like sort of surprised, you know. Kids love it. It's great, right? And every one of these probably has a credit card tied to it. There's going to be 50 million of these sold this year.
Number 1 sale market right now on publishing on those is pre-kindergarten.
Yeah, so I've got like I've probably got like 20 or 30 like kids books and other games on here. You know, $2 to $5 an item. I'd probably be willing to pay $10 to $25 a month. We've invested in a couple of game-based education companies for language and other learning. Like, it's going to be an amazing environment. It's so much easier to use, right? Okay, I know I'm probably going over, but I'll talk a little bit about incubators really briefly. So what's been happening is lowered production cost, maybe not lower distribution cost, but easier, more predictable distribution cost, right? More niche focus on customers, smaller acquisitions, but more of them, right? So we're like increasing the cycle time. It's getting tighter and tighter and tighter and tighter and smaller, less cost structure. And so what can we do? We can start to do lots of experiments. Now they may still fail, but for less than $100,000, we can probably do a lot of experiments. So a lot of venture capital companies were structured around, let's say, 4 partners, between 7 to 10 investments per partner over a period of 3 to 5 years. They would take a board seat in each of those companies, and they would hope that one of their companies would work. And out of the fund, they hope that 2 or 3 actually had large exit opportunities. So they're doing maybe 30 investments. They hope that probably 3 have some material value and that one of them is size of fund or better. Really need 3 that are size of fund or better. Most VC funds are aiming for at least 3x return over a 10-year period. The performance associated that ones that would do at least 2x probably survive, right? But they're running $250 to $500 million funds, right? So they need, you know, they're going to make, an individual partner is going to make 5, maybe 8 bets in a period of 4 years, 1 or 2 bets a year. They're going to sit on 5 to 8 boards, and they hope that one of those companies is going to be a $250 to $500 million exit. Those are really tough odds. Really tough odds, right? But now, and so their individual investment size is probably around $3 to $10 million, right? What can I do with $3 to $10 million? I can invest in 100 companies with $3 to $10 million. I have invested in 100 companies with $7 million so far. Right? Now, a lot of those are going to fail, but probably, I think, anywhere from 20 to 40 of them are going to be successful getting to the next round of funding. And hopefully, at least 10 to 20 of them are going to be successful getting the next round of funding. And somewhere in there, we're going to start to see some acquisitions and exits. Right? So we have this high fail rate, which might be as high as 2/3, maybe even in 80%. But it's cheap to fail. Right? And so we can do a lot of these small experiments. We start with a large sample size, and then we have a lot of collaboration environment going on, right? So there are people that are working on similar platforms, problems, and solutions. So again, they might be learning. I have 5 different experiments going on the YouTube platform, 5 on Facebook, 5 on, you know, sort of native search. I have people working on family and parent and education problems. I have people working on financial services problems. I have people working on sports and entertainment, right? And somebody's going to figure something out, right? And then maybe I get the rest of the portfolio or other people in that portfolio to figure out and learn from them, particularly if they're in a close proximity environment. So we feel like incubators, somewhere around the 15 to 25 company number, you get this critical mass effect where some percentage of them are going to succeed. And enough of them are going to succeed that they actually compete with each other a little bit and learn from each other a little bit. And so we're not really teaching them, we're letting them teach each other, and we're facilitating this collaborative environment where they learn from experimentation. Explicitly around customers, industries, and platforms, right? Those are the 3 things that we try and like figure out. Okay, platforms, there's information to share around that. Different industries, there's problem sets around that. And different customer segments, there's things that you can share around that. So we're setting up this learning environment, big petri dish, A lot of failure, but some people are learning in each of those areas. And as they learn something and figure something out, they get to the next level of funding. We do incremental investment based on that level of success. So in this example, Facebook fund that we ran, we had 22 startups. We put about $35,000 each into those companies. About 8 of them got funding at the seed level. So about a third succeeded in moving from incubation to seed. Among those 8 so far, it's about a year, year and a half later. It looks like 5 or 6 of them are still out. 1 got acquired, 2 other small acquisitions, but 1 sort of notable one at $10 million. Wildfire is doing great. Raised a bunch of money, 70 people. I won't share all the revenue figures with you, but they're doing fabulously well. And probably 4 or 5 other companies there that look like they might be successful, right? So high fail rate, but a few pretty amazing successes that came out of that. And we started out with this sort of 3-month program that was around technology, design, and marketing topics. And then at the seed level, there was a bunch of other kind of angels that come in, and at Series A, there's other venture capitalists come in. But you start to have this structured ecosystem where maybe of those initial 20, 8 get to seed, maybe 5 get to Series A, maybe 2 or 3 get to Series B, and probably I have 2 or 3 exits, maybe 1 large exit and a few small exits, right? It's a much more rational way to be building and investing in companies. And from their perspective, it's probably a much more rational way to be learning, at least at the incubation and seed level, because they see other experiments going on and they see other things that are successful, as well as things that fail. I'm not going to dive into all the lean startup stuff. We don't have a lot of time on this. If people are interested, Eric Ries, Heaton Shaw, Sean Ellis, Steve Blank have a lot of great material on all this. But the thing that I'll leave you with is there's pretty much 2 phases in startups' life. One is figuring out who the customer is, and to some extent figuring out what the business is, and then growing that and iterating on that. Some interesting books. This is kind of off topic, but Jeffrey Miller, one of my favorite authors right now, wrote a book called The Mating Mind, and a book called Spent, Sex, Evolution, and the Secrets of Consumerism. Fascinating book. Behavioral psychology and consumer marketing applied to the internet. Just absolutely fascinating. Other books, the first one you've probably heard of, Influence, Psychology, Persuasion, classic sort of marketing psychology book, about 20 years. Other one, interesting in comics, interesting I think for the web because it talks about the use of images and text, usually static, in transition. And that's, for the most part, our experience on the web, although video is starting to change that. I won't get into Kat's here is awesome. But what I really want to talk about, so Steve Blank is basically saying applying a lot of the ideas that Toyota used in Kaizen and discovering customers and kind of bringing that to the customer discovery process. So figuring out what is a customer, what will they pay for, what's the solution I'm trying to find. And then once I found kind of this thing we call product market fit, then scaling up. Right? And from the internet perspective, this is building the product and learning about customer channels and then scaling up. I think Eric Ries, popular for taking these ideas from the offline world to the online world and thinking about it in this iterative cycle, right? How do we get lean doesn't mean spend less money. Let me say that again. Lean does not mean spend less money. Lean means move quickly and expend less energy, whether that's resources, time, money, whatever, on learning, right? And increase the cycle time as fast as you can around sort of your expenditures in those areas. And hopefully you learn something either on the product side or on the marketing side that allows you to iterate more tightly into kind of what a particular customer segment is interested in. And then Sean Ellis, a lot of things, but one of the things I think he's really most known for is kind of not doing a lot of spend before you figure out some combination of fit for product and market. So spend a lot of time but not a lot of money understanding whether this solution set fits a customer segment, and then once you kind of get lock in on the customer segment and the product fit, then spend money to scale up. Spending money before you get to that point, not very useful. And I did something called Startup Metrics for Pirates, which talks about a way to think about how you allocate product and marketing features into a couple of different buckets of behavior, which is popularized here. But anyway, the things that you think about building a business tend to be around users, usage, and money, and usually it's usage first. So how do I get activation, initial happy experience for a customer, and retention, right? And don't scale up until I get that part figured out. So something the users use and come back to using, and hopefully there's a business model there somewhere. And then once I sort of figure out that, okay, they have this happy experience that they come back to, now I start scaling up the users, and whether that's from referral methods or other organic or paid methods, and hopefully I figure out how to make money at some point in that. I'm going to skip ahead a little bit. So This last piece I will talk about is kind of how we think about investor metrics now, and this is what I think is the operative change going on from the investor's perspective. It's not spray and pray. I know that's the public criticism, and yes, there's challenges in figuring out how you scale the process, but there really is a little bit of logic to this, which is that it costs less to build experiments. And it costs less to acquire customers, or at least it's more measurable to acquire customers. So the reason that we're doing lots of it is because the fail rate's still high, but the cost structure is low, right? And then we do quantitative, incremental investing on a quantitative basis in the stuff that works. So of those first 100 experiments, assuming 30 work, right, then we invest a little bit more in the 30 that work. And of those 30, maybe another 15 or so figure out sort of market and revenue. We invest a little bit more in those. And eventually we get to something that actually is meaningful for hopefully customers and for the entrepreneurs. We think about this in product market revenue. So product validation, hopefully in $100,000 or less, maybe in an incubator, maybe not. Marketing validation, customer acquisition channels, hopefully in $1 million or less. It might take more than that, might take less. And then venture business, once I'm sort of seeing it scale up and I can at least have some predictability around it, then I start piling in real money, right? So at the product stage, I'm looking for a minimum viable product for some non-zero number of customers. Maybe it's your mom, maybe it's 1 or 2 customers. It doesn't have to be a lot of customers. You just want to show that somebody will use it and that they might pay for it. Right? That's functional use. I've built the product, someone cares about it. Progress to the next stage. How many people care about it? What would they pay? So how can I acquire those customers? Which channels? What does it cost to acquire them? What will they convert? What will that behavior convert to if they actually start paying for something on a transactional basis or maybe on a subscription basis? And I start to build this model for customer acquisition cost and revenue generated. Right? That gives me a sense of how big the market is, what it takes to acquire them, what they convert to, how long do I actually have them. Now I have some financial metrics to start to build a model around saying, oh, how big can I make this? Right? And then I make the venture bet. Right? And now I'm trying to get to operational break-even at some point on the horizon. Maybe if I'm really aggressive, I'm still going to build for growth and not build for revenue, particularly if I think there's a really large market and not much competition, or maybe there is competition and I want to get ahead of them. Right? But now I'm not making blind big bets now. I've got operational, infrastructure, and I've got, functional product use, some understanding of customer acquisition channels and costs, and I'm starting to make rational bets. And maybe, like I said before, I can do that on debt. Right? If I can prove customer acquisition cost, particularly in 12 months or less, is profitable, I shouldn't do that customer acquisition financing on equity. I should do it on debt. Right? That hasn't quite happened yet, but it probably could in the future. Question in the back?
I feel like that's the hard part, though, is that, I think a lot of companies are exactly there where they'd like to do it on debt, but there's no one out there that's handling that.
Right. That product will probably exist in a couple of years. I know that there's people talking about it at Silicon Valley Bank and a few other places. And individual funds, venture debt funds, might do it because their business is somewhat similar in ways. But this is kind of advanced. That's more prediction over the horizon. Yes, really quick.
Just a quick question from the company's perspective.
Yes.
What do they need the money for?
What do they need the money for?
What do they use it for?
So at this stage, well, it depends on whether they have their own savings. So a lot of people might be able to save $5,000 to $25,000, and depending on whether or not you pay yourself, that might get you a couple months, or might get you, production costs for part-time work. But somewhere between $25,000 to $100,000. You probably run out of personal savings, or at least you don't want to risk your own personal savings. And that's typically where I see the funding gap, right? So angels start to step in where individual entrepreneurs don't have savings north of $25,000, or they don't want to put their house, take out a second mortgage. Some of them will, right? I ran a small business where I ran up $110,000 in consumer credit card debt. And so you can do that. It's a little crazy. I think in this market, I would probably take 10 to 20% dilution for not having that crap over my head, but depends on your tolerance for risk. So there's this functional product, kind of, can I build the product and will someone use it, that hopefully is between 3 months to 12 months. I don't think you should be spending more than 6 to 12 months trying to find a customer. Maybe if you're building really something deep IP, it might take more than that. But 2 to 3 people, 3 to 6 months. Maybe in Silicon Valley you can get away with $5,000 to $7,000 per person. We're modeling this number at around $75,000. In some countries, it could be a lot less. It could be $25,000, could be $10,000 in some countries, right? But it's probably less than 100,000, maybe even with a pivot or two built in there, right? So I'm figuring out functional use. Maybe to the investor, I'm proving that I can build a product, and I'm trying to find a couple customers, right? Great. That's from the investor standpoint. You've proven that you can build a functional product, and somebody cares about it. That's a de-risking at one stage. Next stage is now, how big's the market? How much does it cost to acquire the customers? What would they pay for it? Right? So those are big questions. Those might take a little time to figure out. But the great thing is now I've got 5, 6 different distribution platforms to go after. I've got lots of ways. Challenging marketing problem, but great opportunity for the company to acquire customers. But there's not that many people who understand how to do that. Like that's two of the biggest challenges in hiring for technical founders. Great front-end design UX person. The other one is an analytically driven marketing person who understands technical distribution methods and still understands a financial model there, right? Because I want to be able to test how many customers could I get from different channels, what's that cost look like, it might get better over time, conversion might get better over time, what's some guesses at revenue. And once I start to get that model together, then I've got enough of the data to go to a venture capital and say, here's what I think it will take us to get to operational break even, right? And if they have really provable metrics, again, I might not go to a venture capitalist, I might just go to a banker, right? And maybe if I figure out enough money, I could get someone to just like help me do that, right? If I get something that's really cash flow positive, maybe I don't need any money at all. Maybe I can just like do it out of cash flow, right? And then, you know, the venture bet is traditionally a bigger bet, and you know, this may or may not be part of that world for the $50 to $100 million exit. But there's still plenty of room for venture to pile in. And you know, there are companies that need lots of capital, even you know, in efficient markets. So what does this all mean? I think it's going to mean a lot of smaller funds. There's still going to be a place for big venture capital. But because I think there's going to be lots of smaller exits, I think and because you don't need as much money, there's going to be more incremental distribution of capital. Because of these platforms, I think you're going to see a lot of focus on distribution and monetization, not so much on technology. One other thing is I think in the investment funds, it'll start to drive either two things happen. One, check only, not too much expertise, right? Purely monetary intensive strategy, or domain-specific expertise, which is I'm your investor, but I also happen to know something about engineering, design, or marketing, right? And we're trying to do a little bit of this and a little bit of this, right? So at the incubation stage, we're trying to build resources on our team that are domain-specific in engineering, design, and marketing, build a large mentor network, people who actually work at the companies that we're trying to figure out. And at the same time, we have this other strategy, which is we'll write a check, and we'll hope the entrepreneur figures it out, right? We may have a little bit of filter on the selection side, but we don't really presume that we are going, even if we're smart, I don't think that we affect the equation more than 5 to 10%. It's still mostly the entrepreneur, right? But maybe we're a little bit smarter in how we apply those resources. Maybe we can do some other things, right? And then we take this approach that's really lots of small experiments, but still kind of a, you know, a scalable strategy. And you know, we expect that there have to be other investors that do take the smaller bets, larger checks strategy. So even though I rip on large venture capital a lot, we still need them, right? And they're still needed by a lot of entrepreneurs, because you're not going to get as much attention from me as someone who sits on your board and only has 5 companies. I've got 100, right? Even if we scale up, it's still going to be a challenge.
Do you try to keep them all in the same proximity, in the same system?
No, I didn't talk about that, although we have probably 2/3 of our portfolio is in Bay Area, another 25% are kind of around the country, and then even 10% are around the world. So we have 10 companies outside the US, 4 in Asia, 6 in Europe. Actually, a couple in Canada now, too. Probably have 5 to 7 in New York, a couple in LA and Boston, some more in Seattle. Still, most of the behavior is here, most of the activity is here. But there is some interesting network effects that you can also gather by having a little geographic spread. Yes?
Have you seen the guys in Europe, those ones which have failed, the guys come back to the door saying, okay, this didn't work, but let's try that one?
Yeah, I mean, I'm willing to bet on people who failed once as long as they show me they learned something. Because I'm one of those guys. Yeah. I failed too, and hopefully I learned something. Yeah. I mean, failure is pretty common. It's what you do with the information that matters. Sorry, yeah.
So if one of your companies fails, how do you set up, what happens to the IP that did get developed? Is that,
what is IP? Yeah, I mean, there's value there. I would say because a lot of things we're solving are more straightforward, less, you know, expensive. I don't worry so much about that. I'm not in the salvage business. I'm in the make money business. So even if there's 20 to 70% of value there on a salvage, if there's 70%, I probably should care about it. If there's 20 to 30% there, I'm not sure I need to care about it, but maybe somebody else should. I know that's a crappy answer, but I'm trying to be rational about it. At scale, it's hard for me to care. I don't know. I think in the back, yes.
So it's really good that there's so much money right now for entrepreneurs, but it's actually creates also another problem. That we kind of see that the top tier of developers are actually going to start their own startups right now because it's easy for them to get money.
Right. If you're trying to build a large company, there's a lot of talent drain.
Twitter because they offer companies.
Yeah. Jeff Lawson, it's really always gives me shit. He said, "I'm single-handedly create a problem in the Valley because you can't hire great product managers. They're all being funded by other VCs."
Do you see more outsourcing in your companies, or do you?
Outsourcing?
Suggest for your companies?
Well, yes. I mean, I do think there's talent everywhere. I think managing talent remotely is challenging. Doesn't mean it can't be done. SlideShare is a company we're invested in, and most of their operations are in Delhi. I think they have 25 people there. They have 5 or 7 people here. But one of the founders is there managing the team, so it actually works pretty well. There is talent all over the place, and it just depends on if you can get comfortable with managing remotely across time zones. Some places you don't. I guess if you go to South America, sometimes you don't have to go across time zones from here. I actually think there's a lot of organizational complexity in businesses larger than 50 people. I'm not trying to figure that out. I'm trying to optimize. Again, that's a risk issue for me, right? Like, it's easy to manage a group of 5, and it's kind of easy to let them manage a group of 5. But it's starting to around 25 to 50 or maybe 75 people, you have to start to develop organizational process or things break, right? So it's not too hard to manage a company of 25 people. It's very hard to manage a company of 50 to 100 people. And scaling beyond that, I'm not good at it, right? So I prefer small company size.
How do you track so many startups?
How do I track it? We're still working on that. I'm trying to figure it out. We got to build some internal processes to do that. We don't have to keep track of all 100. We have to keep track of the ones that are working. I know that sounds really harsh, but that's the reality. I think him and then her. Yes?
Yeah, I have 2 questions. What's the background of your founders usually?
Of the founders?
Do you have a lot of founders with non-engineering background?
Most of our founders are technology founders. That's usually a requirement for most businesses that we built, although Sam's here in the audience. Maybe he left, but he was a non-technical founder. Craig, do you call yourself a technology founder or not? Oh, yeah. See, he's probably not, but he's saying he is. He's the business guy, really, but he's got technical. So here's the thing. I think the perfect team construction is probably technical founder of some sort, design, UX-oriented person, business marketing person, ideally that analytically focused marketing person. Like the person who knows how to write code, person who knows how to build UX. Not all businesses require that, but a lot of ones that we invest in. And then how do you figure out distribution? So those are sort of the 3 roles that I like to see. We don't always see all of them when the company gets started. Usually it's the technical founder that we see. And then we try and find or match the designer founder and maybe the distribution person. We're starting to think about setting up a specific focus on funding designer-oriented founders. There's actually some pretty successful folks who do that. Chad Hurley was one of the people at YouTube who had a design background. I actually worked with him. Jason Patorti from Mint is now working at a company called Vodazen. He was a designer founder. So we think there's probably good reason to think that the design skill set is as important as the technical skill set. And I think if you really thought about it, the marketing analytically focused distribution skill would be as important too. Doesn't mean that's the only way to do it, but that does tend to be a lot of it. Lois?
This week, there's about a dozen startups that I know that you may not be interested in, but
yep.
What is your vetting process? I mean, how do you
What is our vetting process? Great question, because I don't want you to bum rush me here, and it's really the worst way to approach me. Coming up and try to pitch your business to me right now after the business, it's not going to work. It's not scalable. And even if I do listen to you for 30 to 60 seconds, it's not going to dramatically change my opinion. So we have a pretty large network of people. We have about 120 mentors. We have probably 100 company founder, 100 companies are probably 150 to 200 company founders. So we have easily 200, maybe 250 people, a lot in the Bay Area, but all over the world, who we consider to be domain experts that we've already bet on. We love their opinions. So, you know, we probably, if we see a company that we like, we'll send them to 3 of our mentors to kind of get their opinions on. So if you go to talk to those people first and you get their positive approval, or heaven forbid they even write you a small check, that makes it a really much better way for us to make decisions. So we have to depend a lot on crowdsourcing the first opinion, if not even the first check. And we'll probably do more of that in the future. Yes, question? I have no idea what time I have, so cut me off if we're done. About platforms? Yeah. Yep.
It seems that the stronger the platforms become,
yep,
the more expensive it becomes for anyone who wants to use it. For example,
yeah.
Can you speak louder, please?
Casual games.
Stronger platforms become, the more monopolistic behavior they have, the more monopolistic pricing occurs. It's true, but again, we've got 5 or 6 platforms out there that are working, so there's a pretty interesting competitive effect going on right now that I hope keeps Facebook and Apple in check a little bit, because they're really pretty harsh. In some ways, I guess I should say. The one thing that's great is, you know, everybody bitches about Apple charging 30%, but you get to keep 70%. Carriers are much worse. Carriers are so much, they're bastards and they don't know anything about UX and distribution a lot of times. So it's a pretty good world to live in right now. Even if they're monopolists in their own segment, in the overall view of the world, they have to be a little bit competitive, or the developers will move from one place to another. I think you saw a little bit of that where the development community went from Facebook to Apple 2 years ago.
So it's probably fair to say that the fact that they exist makes life easier for everyone. But it's probably also fair to say that with time, as they get stronger, things will not get better.
Things will get worse on any individual platform, maybe. You know, maybe, but you know, that's market economy, and so they'll, you know, Microsoft used to be dominant, and then Yahoo was dominant, and then Google was dominant, and then Facebook was dominant, and you know, Apple's now resurgent again, and so I think, you know, in the course of 5 years, there's actually been a fair amount of competition going on for the developer community. Certainly in the course of 10 years.
I guess 2 more questions.
Okay, in the back there, and then Matthew. Yes. I was an okay developer. I was an okay developer, shitty entrepreneur, pretty decent marketer. Hopefully I'm a good investor, we'll see.
But now, is it fair to say that you are in business of investing?
Primarily. I do consider myself an entrepreneur, and that I'm trying to reinvent some ideas in venture.
Right. So when I'm thinking of investing, the motivation is return.
Yes.
You mentioned that a certain percentage of your overall portfolio you expect to return triple in 10 years.
I'm sorry, return what in 10 years?
3 times.
Yeah, that's a typical target for a venture capital fund is 3x over 10 years, although most of them don't get there.
12% on par.
Yeah, hopefully it's a little bit more like 15 to 20%, but you probably want a risk-adjusted rate of return that's 5 to 10 points above market return.
118.
What'd you say?
Rule of 118.
Yeah, you're probably better at that than I am, but the basic idea is for an illiquid security that's 10 years, it better be performing 5% better than the rest of the market, ideally more like 10% better. Fortunately, the rest of the market's sucking pretty bad right now, so I don't have to beat 10% now, I probably just have to beat 5%.
But my question is, so the expectation on your overall investment portfolio when it comes to...
Should be trying to aim for 15 to 20% or better.
Say plus 5 in comparison with what the stock market is doing.
How much do you like the stock market?
I don't like it at all. And I'm asking about your expectations.
Yeah.
I think...
Well, I mean, I don't think I'm trying to beat other market segments. I'm trying to outrun the guy next to me. So I don't have to outrun the bear. I just have to I don't have to outrun the bear market. I just have to outrun the other shitty venture capitalist. Great, that's a new slogan I can run with. That's awesome. I don't have to outrun the bull market is really what I should be saying.
I guess my question is probably another pockets or another segments of market to invest in with potentially high returns. What means you to invest in?
Well, again, because most institutional investors, the people who fund venture capital funds tend to have asset allocation strategies which are determined by a couple of large consulting firms, Cambridge Associates and others. And so typically, those investors will probably put 5 to 15% of their assets, sometimes even more, into private equity, and probably anywhere from 3 to 10% in venture capital. And there's lots of money going into venture capital even if the overall field is reducing. My challenge is I'm a first-time fund manager. This is a pretty different strategy than anything most people have been doing before. But then again, I would say if you look at the performance over the last 10 years in the sector, it's been pretty shitty. So if you're doing the same thing, you're the crazy one, not me. So I think, looking at new ways to apply models that are a little bit more capital efficient in investment. But I mean, I don't know. I've got 1, maybe 2 years of data. So I've got, probably less than half a cycle iteration going on here. In another 2 or 3 years, I'll maybe have 1 or 2 cycles. So, but I do think you're going to see more of this model. I mean, Paul Graham's probably the oldest guy with 5 years, maybe Ron Conway with 10. Was that the last question? John, Matthew, sorry.
Do you invest in hardware, like physical stuff?
Do in hardware? A few. We've done 2 or 3 investments. WakeMate, company out of New York. It produces a 3D printing surface, MakerBot, sorry. See, when you have 100 companies, it takes a while to actually remember the companies.
Companies that take longer than 10 years to show real big results?
No, not really. I mean, so it's questionable that we should even be investing in hardware. Usually we're doing that when it's combined with software. There's one other company we're looking at that's doing for the infant market that might combine, a software product with a monitor, hardware-produced monitor product. We're talking about that. So hardware-software combinations are pretty interesting because actually small-run, custom-produced hardware is actually getting cheap now. So you can do probably runs of less than 1,000 for custom-produced hardware without killing yourself on the production cost. Still a little bit challenging. Got to know China pretty well, I think, for that, for the most part. Probably done?
Hi.
Yep.
Stay tuned on our website and we'll have our next event in about 2 or 3 months.
So remember, don't pitch me. Find someone in our portfolio to pitch.
Where can we see these slides?
The slides are on slideshare.net. You Google Lean VC, you'll find that stuff.
Did you actually have space in that?
Yes, we did. I probably didn't mention that. But,
I was going to try to ask that, but you've already shot all the questions. What's your square footage? How many people?
10,000 square feet, probably right now.